If you're using a HELOC to access home equity, there's one mistake that could keep you paying interest for the next 20 years. And you might be making it right now. By the end of this video, you'll know exactly how much you can borrow and what it'll cost you, and whether the HELOC makes sense for your situation. Plus, I'm showing you the setup I use personally that has saved us from making a massive cash flow mistake. I'm Dion Williams from Williams Mortgage. I help Canadian homeowners get mortgage free faster. I've worked with hundreds of clients across the country, and HELOCs come up almost every conversation. If you want to chat about your specific situation, click the link below and book straight into my calendar. And hit that subscribe button so you catch the next part 2, where I break down the smart strategies and the mistakes that cost people thousands. All right, let's get into this. The confusion of what is a HELOC. HELOC stands for Home Equity Line of Credit. It takes the equity you've built in your home and it makes it accessible to you as a revolving line of credit. Here's the thing most people get wrong. A home equity line of credit, a HELOC, is a mortgage. I don't care what anyone calls it. If you're borrowing money secured against your home, that's a mortgage, period. Most HELOCs are set up as a collateral mortgage, which means the mortgage you owe can go up or down as you borrow and repay. It's not like a traditional mortgage where you're just grinding down that principal. With a HELOC, you can borrow, pay it back, and borrow again up to your limit. Drop a comment below if you've ever been confused about whether a HELOC is actually a mortgage or not. You're not alone. Here are the numbers and how they work in Canada. You need at least 20% equity in your home before you can get a HELOC or unlock the equity. It's simple. It's your home's value minus what you owe. Let's say your home is worth $673,000. That's roughly the national average right now. And let's say you owe $540,000 on your mortgage. That's about 20% equity. Once you've got more than that, you can start tapping in. But here's the rule. You can borrow up to 65% of your home's value through a HELOC. On top of that, you can have a conventional mortgage for another 15%, bringing your total borrowing to 80% of your home's value. So on a $673,000 home, you could access up to about $437,000 total. But that includes your existing mortgage. The HELOC portion maxes at 65%, which is around $473,000 minus whatever you already owe. Make sense? If this is clicking for you, hit that like button right now, because most Canadian HELOCs are interest-only payments. There are exceptions. Some lenders offer fixed payment structures, but the big players usually offer interest only, where you're only required to pay interest on what you've borrowed. Right now, as of early 2026, prime rate is sitting at 4.45%. So you're looking at somewhere between prime plus half a percentage point to prime plus 1% on your HELOC rate. That puts you at about 4.95% to 5.45%. The exact rate depends on your credit limit, the size, and how strong a borrower you are. Professionals like doctors and lawyers often get better rates because lenders see them as a lower risk. Like any variable rate product, your HELOC rate moves with the Bank of Canada's adjustment on prime. Your markup stays the same, but your overall rate goes up or down with prime. Here's the key. You only pay interest on what you actually use. Got a $100,000 availability, but haven't drawn anything? You pay zero. Borrow $50,000, you pay interest on the $50,000 only. Pay it down, interest drops too. A lot of people keep a HELOC available for emergencies, but don't touch it. That's smart. If you're disciplined with credit, Here's a pro tip. Once your mortgage is paid in full, some folks keep a small HELOC registered on their property, not to borrow, but to help protect against title fraud, where sometimes someone tries to register a mortgage against your property without your consent. Having a small registered mortgage on title can block that. Now, here's where it gets interesting. Some HELOCs are combined directly with your mortgage. It's what's called a readvanceable mortgage. This is set up, and I've used it with my clients, and it's powerful. Here's how it works. As you pay down your mortgage principal, your HELOC limit grows the same amount automatically. So if you pay $2,000 off your mortgage this month, your HELOC limit increases by 2,000, and you can borrow that money back out if needed, often for investing or business cash flow. We use this setup because when you run a small business, every mortgage payment frees up that same amount in your HELOC. We don't always use it with all our clients, but having access to it is a safety net. Just last month, I helped a client restructure their mortgage into a readvanceable setup. They were able to access $35,000 in equity they didn't even know they had. We used it to consolidate about $28,000 in credit card debt and saved them $650 a month in interest payments. It's like having a financial cushion that grows automatically as you pay down your mortgage. Pretty smart, right? Comment below if you do have a readvanceable mortgage or if this is the first time you're hearing about this. All right, that's the foundation. You now know what a HELOC is and how much you can borrow, what it costs, and how readvanceable mortgages work. But here's what most people mess up: knowing how to use a HELOC strategically. In part two, I'm going to break down the smart moves of paying off high interest debt, investing, business cash flow, bridge financing, and the mistakes that trap people in debt forever. If you want help with your HELOC strategy specifically, click the link below and book a call, and we'll look at your numbers, your goals, and build a plan that actually works. Hit that subscribe button so you don't miss part two. And if this helped, smash that like button. See you in the next one.